that's something that you want good ratings for, because it's a lifetime contract. If you just want an interest rate play, the interest rate almost, the ratings of the company probably don't matter as much, for short-term MIGA. But the longer that we want that contract in place, I need an A minus on up rated company. I need a company that's going to be around for quite a while.
Yeah, the higher the better.
Yeah, generally speaking. But still, the payout rate is an important factor too, and other terms, definitions,
right. And
the whole package.
That is an interesting thing, is that generally, the higher the rating, the lower the payouts tend to be. But that's probably partially why they have the higher rating, because the money is more secure and they're a more secure company. So,
and basically, they don't need to buy that business. The lower the rating, the more they're going to buy that business by offering something that they otherwise would not be able to do. That's why they've got to offer it that way. So I see a mix of that,
because
right,
you start taking a distribution out of that, and then you're really up a creek without a paddle. But the point is that the longer your time horizon is, obviously the more risk you can take, because you have more time to recover. So a lot of people will talk about how just investing in the market and just keep investing and whatever else, and the market always recovers. Well, it does, and it doesn't, because it depends on what side of the mountain you're on. And if you're on the wrong side of the mountain when that correction happens, that's where we find people, that thought they were set up for retirement, suddenly working at McDonald's again.
And remember, the average time horizon, I'm going to go back to Alonso's question, which is the average time horizon for investors. It depends on what you're saving for. And There's a lot of investment ideas where they want to separate or segment your accounts. So here's your retirement accounts, but here's your college savings plans for your kids. That's a different time horizon than your retirement. I mean, I am 47 now. I got 3 kids. One is 21, one's 19, the other one's 17. What's my time horizon for my 17-year-old? 1 year. This is not the same as a 20-year horizon before I'm 67 to retire at full retirement age with Social Security. So that's a different thing. You got to take the different time horizons towards the different goals. Sorry, Rebecca. Okay.
I know your daughter, and she's not, anyway.
Wow. No, I get to say that. You can't say that. Okay. But
she's not going to be very happy with you.
So that's not going to be helpful. But let's suppose that I had a nice portfolio and it went down 30% right before we want to get her into USC. That money's not there, essentially, if I want that money to be there to recover. There's only one advantage of that, which is I could probably write off the losses. But you have to sell out in order to realize that loss. So time horizons, it's important depending on where you're at and what you're saving for and what each account is set up for. And the nice thing about having the cash reserve of life insurance, for college planning, the whole thing's an exempt asset. It's not reportable on the FAFSA, so that's a good part. That means you can use it and deploy it as much as you want. It doesn't affect your expected family contribution, as we talked about a couple of weeks ago.
And it doesn't even have to be used for college.
Doesn't have to be used for college. It can be used for anything. In fact, you could set up as the family bank. You could set up for college, and then you have the student, once they graduate, set up their own repayment plans back to the family bank, and you make it far more advantageous. There's a whole book on that. Was it
good? I thought this was a good one. It depends, man.
It depends. And this year is going to be a whole nother thing. At some point, once we finish up our financial literacy series, we'll get back into current events, and we'll have to do a year in review for the month at some point.
As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain liquid securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com.